Chapter 25, what you've been waiting for. This is differential analysis, product pricing, and activity-based costing. All right, this chapter has really lofty objectives. It has a lot of information. This, to me, differential analysis for a variety of managerial decisions, this is a whole chapter. And then determining selling prices, that can get added with something else, but there's some good concepts in here. Bottleneck production processes is another issue, and then the last piece they've got in here is activity-based costing, which, as I said, is another chapter to me. So we are not going to do these two because it's okay. Because, I don't know, they're separate topics, and this will be fine for now, okay? Perhaps some other day we'll do this, but right now we're going to focus on these two things, and we're going to do it a little bit differently. I'm going to do a concept in here for one type of decision, and do a brief presentation. Then we're going to do a problem together. All right. So we'll do a lot of talking about it, and then a problem type format for all of these. And then for selling prices, this will be more. I'll discuss what the issues are and figuring out how you're going to price a product, and then we'll do some problems on it. Okay, but the real emphasis in the chapter is just on this one objective, just on one. So managerial decisions involves, making choices all the time, or people have a better idea. Should we keep doing it this way, or should we do it this way? So what we do is we look at the information that's different. Okay, we look at what it's called differential analysis, and we want to focus on what's going to make a difference in our decisions, okay, what's meaningful. It's also called incremental analysis. It analyzes differential revenues and costs in order to determine the impact on income of two different courses of action. Okay, so we'll look at different differential revenue, costs, and then finally the bottom line would be income. Okay, and it's a nice format. It's 3 columns. Choose this one, that's the difference. That's the idea. So the first one that we're looking at is, this is more or less just an example of how this could be used rather than a category. But this is a restaurant that's trying to decide what to do with their floor space. And they've got existing tables right now where they've got like table service, or should they replace the tables and put a salad bar in, replace some tables. And each alternative has revenues, costs, and income. Now the revenues with having the tables is $100,000. They think the salad bar is going to bring in $120,000. The costs are $6,000, another $5,000 in costs here. So we've got income of $40,000 with the first one and $55,000 with the second. Okay, and the real point here really is the format. And here's the solution. We've got we'll make $20,000 more in revenue, and it'll cost us $5,000 more in cost. Okay, and for this differential effect, what you do is you put the effect on income in the last column. All right, not whether it's higher or lower or something like that. You've got to really think of the impact on income. So in this case, the expenses are higher using the salad bar, okay, but the effect on income is it will reduce income, right? Okay, so the difference is $15,000. Yeah, and they're just explaining how it works here. Differential revenue is $20,000, and because the increased revenue would increase income, it's a positive number in the income column. Differential cost for the salad bar over tables is 65 versus 60, or a $5,000 difference. And because the increased cost will decrease income, it's entered as a negative in the differential effect. Okay, so all in all, the differential effect of the salad bar over the tables is $15,000, and it's determined by subtracting the differential costs from the differential revenues in the differential effect on income column. Okay, so doing so, if they do this, it'll increase their income by $15,000. And after a while, you want to take a look at your actual costs and revenues, and and compare this to what you thought it was going to be. Now, here's your first real category. Well, this is one side of it. Usually we're going to look at it in a different way on our example, but this company has some equipment that it doesn't need anymore. And the question is, should they lease it to someone else or should they just sell it outright? Okay, and this can occur maybe if a company changes their manufacturing process or they change something about what they're doing and they can no longer use the equipment that they've got. So you could use differential analysis to make the decision. And here are the facts that the equipment costs $200,000, the accumulated depreciation is $120,000, and the book value of it is $80,000. Now, you know what we know about this? These are all sunk costs. They're all in the past. We can't change them. So when we analyze things this way, what we do is we just look to the future. Okay? So the first alternative is we could lease it, and the total revenue for 5 years would be $160,000 with about $35,000 in estimated repairs over its life. Otherwise, we could sell it right now for $100,000 with a 6% commission. Okay. Now it's a little bit tricky here. I've never seen this type of analysis done, especially over a 5-year period without using the present value. Okay, but they don't have any in here, so they don't have any in here. Just so that you know. And here's the lease. If they lease it, they've got $160,000 in revenue. They anticipated $35,000 in costs, so the income is $125,000. If they sell it, they get $100,000 today minus 6 for $94,000 of net income. And so the differential effect on income is $31,000 in favor of leasing. Okay, I'd still be tempted to sell, but that's what it is in favor of leasing. Okay. So this is lease or sell equipment. The one I want to look at would be lease or buy. Should we lease this asset or should we purchase it? Okay. Only the differential revenue and the differential costs associated with lease or sell are included. Okay, the book value, the cost less accumulated depreciation of the equipment is a sunk cost and is not considered, okay, in the analysis. And sunk costs are costs that have incurred in the past, cannot be recouped, and are not relevant to future decisions. Okay, no matter what you do, you can't change that $80,000. So it just is. And this is the next one we'll start off with is discontinuing a product or a segment of business.